Hello and welcome to Hedgeye NexGen. I'm Ryan Ricci, and this is where we help you build wealth and break down finance into its simplest form. Today we got Hedgeye food.
Richie, it's a great day. There's a great NexGen episode on the slate for today.
This may be one of my favorites yet.
The Wall of Shame.
Yep, the Wall of Shame. I told you guys all, send me in your advisors, and that, by the way, you can still send them in, NexGen@hedgeye.com. You get right to me. But we pivoted a little bit from the advisors because, well, we didn't really get a lot of people sending stuff in, unfortunately, but that doesn't stop me.
We need an active chat today.
We need a very active chat. We're making the Wall of Shame of ETFs, okay? So we got our tier list here. So what we're going to do is I'm going to go through. We have about 20 of these ETFs, and we're going to start ranking them. And we got some categories here. We got the CEO's Yacht Fund. Okay, we got the premium scam service. We got overpriced average. We got could be worse. We are in Cabo all of 2025, and we got hand-me-down shorts.
So good. Where at the top, S tier is the worst.
S tier is the worst.
Say the S tier is the worst.
Worst of the worst.
And then work our way down.
That's where
these are all bad. But we're gonna
nothing's really good in this list.
We're gonna rank the shame. Just the shame.
Just this absolute shame. So guys, by the way, when we go through this, you should have a chat, right? And so we'll put up a ticker. You guys tell us where you think it should be, how bad it is. We want to hear from you. And so, yeah.
That's what we're doing.
Let's just get this all started. Chat with Ryan and Bennett here. Yeah. It's right there, everybody. Okay, let's go to the first one. All right, I think everybody kind of gets it. We're going to start with BDC Income. It's ticker PBDC. Okay, so these. Okay.
Oh, you're starting off high.
I really did start
high expense ratio, persistent underperformance.
Yeah, so BDC. I don't know if you've heard of these things. I haven't. They're called business development companies. Okay. It's essentially private credit. Now I can just kind of imagine what they're trying to sell you. They're like, hey, we got private credit. You can't really get in, but we got this vehicle for you. You see, we're going to give you a lot of dividends, a lot of income with these, and yeah, it's kind of like investing in your own little companies. So this is what they do. You got a 10% dividend yield. Right? Imagine going into a meeting, you get a 10% dividend yield every year.
It sounds great.
It sounds great.
Okay, what else? I mean, that's great.
Well, let's just not tell you. We have a 13.5% expense ratio.
Yeah, it's not great.
Every single year, you are paying 13.5%. Okay? 2025, this thing was down 1.5%. And relative to the S&P 500, it was down 19.3% in 2025. 2024 is down 5.5%. Holy cow! A 13.5%.
That's crazy.
Expense ratio. Just so everybody knows, you have to be up more than 13% on the year in order to start making money on this thing. But also, any dividend you're getting, they're taking 3.25 percentage points. So if you're getting 10%, they're taking 13. Really, you're just paying them an expense ratio of 3.25.
And I think of all the names we're going to look at today, right? This has the highest expense ratio, right? Of all the ETFs that we're going to go through. I mean, this is. It's insane, actually, especially when you consider the performance relative to the S&P. What would want to make you own this? You're starting off high. I mean, I think I know where this should go on the list.
Yeah. Okay. What's also crazy about some of these is their assets under management. There's $260 million in this thing.
It's crazy.
I mean, also what probably happens, because this one's a big company that owns this one. Mm-hmm. I guess I could say, you guys can all look it up. It's Putnam. Putnam PB is the one.
Yep.
So I'm sure, right, they got some clients and they're just like moving assets around. Oh, this client's been with us a long time. Let's just move him over into this one. It's insane, but $260 million in AUM, right? Just do the math on that. That's a pretty big paycheck. 260 times 13.5.
And yet you have Seeking Alpha coming out and saying buy the dip. I mean, it's just like, what are we doing here? That was back in November. I mean, this is not. Richie, I think we got to go top. I think S tier. I think this is S tier.
You think this is the yacht club?
I think this is going to the yacht club.
I think you're right.
I really do.
I think whoever's getting
PBDC.
paid, they're getting paid $35 million PBDC. Yep. $35 million a year.
Oof.
Just with assets under management. All they need to do is grow assets, charge you 13.5%. Welcome to the club, PBDC.
Yep.
Welcome to the club. By the way, guys, if you think we got it wrong, let us know in the chat. And we just let us know. All right, let's get this next one.
KBWD?
KBWD.
Okay, so walk me through this one. Is this another, what is this?
This is okay, there were so many, a lot of these, there were so many were high dividend yield.
You're right.
So I think what the ETF world tried to do at some point was say, hey, we have a really high dividend yield, so you can give us your money and we'll just give you income on the other side of this. And they say, hey, we have the highest dividend yield. So these guys have a 12.2% dividend yield, which is like, it's insane. But expense ratio is 5.4%. Okay, not 13%. They didn't quite make it to that. But then when you start looking at like the performance of these things, I mean, this guy, since it's been launched,
I mean, it's terrible.
2010.
There's no way to sugarcoat that, right? It's primarily based in mortgage REITs, right? It looks like, right?
Yep.
The leverage portfolio, some BDCs as well, right? So it's like, okay, same path, right? It may not have the same expenses, but when you look at the performance, I mean,
it's just not good. I mean, just look at this chart versus like an S&P 500.
Yeah.
So also with these,
look at relative over time too. It's not like it has a track record of significant outperformance when you look at the historicals.
Yeah. No.
Right. I mean, it's just in that gap. I mean, the gap is widening, right?
It's
certainly widened in 2024. In 2025, it wasn't great by any means.
No. And like, here's the thing with these dividend yield things. Like, is the dividend yield really that worth it? Here's something you can do. If you have a capital appreciation in your brokerage account, sell something,
right.
sell a little bit of what you got, and then give yourself a dividend. Why do you need a 12.2% dividend when you're just going to by the way, since 2010, this thing was up, I think it's 160% versus S&P is up 630%.
Right.
So you're basically looking at like a 500% difference in your capital. That's bad. That's really bad. And you can see back in 2020, they had the same exact drawdown that the S&P 500 did. And then when you look at relative performance here for the last, going back to 2020, relative to the SPY, they underperformed by 12%, then 20.6%, then 6% in 2023. In 2022, they underperformed by 1%. 2021, they outperformed 3.2%. And 2020, they underperformed by 33.9%.
I mean, it's brutal, right? It's brutal. Really, and lower expense ratio. But I mean, this is, Richie, when I'm thinking about where this goes, right? I mean, maybe this is an S tier, but maybe a notch below. I mean, is this a scam service?
I think we might be at scam service.
Overpriced average. This is less than average. right?
Yeah.
So when you think about where this goes, are we going out to the yacht on this one?
I don't know.
Are we shipping this one off to Denmark? I don't think so.
Because their expense ratio is only 5.4%.
I mean, it's not great. I mean, the performance isn't great. I'm going scam service.
Okay.
On this one.
Okay.
There is no ounce of.
By the way, $450 million in AUM on this thing.
Wow, almost double PBDC.
Yeah.
Wow.
I might go like middle of this scam service because we'll see where we start lining up.
We might get a little more scammy.
Oh, that's not a K. K. Wait, what is it? K.
That's the B.
That's the B.
That's the B.
Yeah. See, that's the B. This is the K.
KBWD.
WD. Okay.
Beauty.
Right there in the middle. Right there in the middle. We'll see. I mean, they're still getting paid though. $450 million AUM, 5% expense ratio. So just for everybody, in terms of what they're taking home on that, 450 times 0.54, they're taking home $243 million a year, something like that. Anyway, that's one of those. All right, we're going next up on our list. Another private credit. We're going private credit and alternative income.
Ooh.
HYIN. So you're going to see a lot of the same characteristics here with all these little dividend things. Dividend yield on this, 12.3%. Okay. Expense ratio, 4.3%. 2025 performance was down 0.5%. And relative to the S&P 500, they were down 18.2% in 2025. You take since they've existed.
Yeah, it's crazy.
Since they've existed, relative to the S&P 500 in 2025, okay, they were down 18.2% versus S&P. 2024 underperformed by 17.5%. 2023 underperformed by 4.3%. 2022 underperformed by 3.0%. Whew, stinky.
Yeah, I mean, it's interesting, right, to see the progressive decay, right? That instantly jolts it more towards the top of the list, right, on a expense ratio that is actually not, it's terrible when you consider the dividend you get, right? But then you look at the performance and not only, the raw number for 25, but progressively over time, as you've mentioned, right?
It's just, I mean, since they've launched, they're only up 11%.
And it's interesting too. I'm just looking up the composition, right? It looks like they don't double layer fees the way that BDC ETFs do.
Yeah.
Right. You're only paying one high ETF fee.
Yeah.
But still, right? I mean, this has fallen because of credit quality and cyclicality. But I mean,
a normal expense ratio is like 1.5%.
I mean, based on the list, based on what we've been looking at, right?
This is true.
It's catastrophic, right?
Well, what do you think on this thing? Because it doesn't have as big of an expense ratio as KBWD. By the way, we saw your chat. We're coming to you. It's got 4.3%, but like
it's down 18% in the
overall performance is terrible.
Yeah, I think overall performance is terrible. It's only got a slightly better expense ratio on a incrementally flat dividend, right? I almost think this goes above just based on the performance.
You're going. It's not as bad. So
No, I'd go left.
You think it's worse?
Yeah, I do.
Okay. I
Do
think
we
for
defer
me,
to the chat? What do you like?
Yeah, chat. What do you guys like? Were you guys above or below KBWD? See, what's getting me?
What do you like?
That performance chart in terms of just price performance, is terrible.
For
HYIN, which is why I think I'm leaning with you.
You're leaning left.
I'm leaning left.
All right.
I'm leaning left.
Lean left?
All good things in life lean left, aren't they?
HYIN. Beauty.
Okay, we got a chat. Okay, they want us to look at CHKP.
CHKP.
Let's find out. CHKP. Software Technologies.
Ooh.
Well, you want like bad companies. AIYY. That thing, pull that one up. Okay, this thing, software technologies. Let's put another software, because software has just been bad in general over here. Let's see, what's their expense ratio?
This is a stock.
No, AYII is not a stock. It is an ETF. Is this one a stock?
This is a stock. We got it.
Oh, this
Checkpoint
is a stock.
Software.
Oh, Checkpoint Software is a stock. Fuck. They got us. Well, we looked at it.
Should we look at it?
I know.
Let's get a little analysis here.
It's down 8%
from last year. We might have to call in the software guys for this one. Checkpoint.
Where's Josh Bolche when you need
know,
him? Maybe he's listening. Josh?
Josh, Nick, any
of you guys?
Checkpoint. I don't know anything about Checkpoint.
I know nothing about these guys. But software's been doing pretty bad.
I guess I can look at it. Let's take a look.
Yeah, but you know what? We love our chat. We do anything for them. I think I'll keep going.
Keep going. I'll take a look at Checkpoint, but
all right, we're going.
Last year is brutal.
We're going to an active small cap fund with the ticker SMLL. Small cap active. So this when you start getting into the active territory for me, you better be beating your benchmark or you better be close. Okay? Small cap active here. Okay, right, we're not going to see crazy expense ratios, right? They have a 2.2% dividend yield, whatever. Expense ratio is pretty normal. But fund performance in 2025 for these guys, Bennett, was down 6.3%.
Oh.
6.3% they were down. Relative performance versus the Russell was down 19.1%.
I mean,
you can't be active and down 6.3%.
No.
That's not good. I don't think your CEO is getting paid on that.
Yeah, I mean, that's not one that you want to. I mean, none of these, right? I mean, this is the wall of shame for a reason. Down 19% relative in 25 is not, especially too when you actually outperform for a good while and then you just fall apart.
Yeah, they had like a little stint there from launch to like June of 2025, and then whatever strategy they start doing, it just went downhill really quick for them. Actually, let's see what their holdings are. I wonder if they have like one big holding.
Yes, you have this chronic small cap lag, but you've shown performance, right? You've shown performance overall, right? You have a low expense ratio. You have moderate fees. I mean, Alpha hasn't looked good over the
last year.
But when you look at it, right? I mean, wall of shame. I don't know. This would go lower for me.
Okay. I'm with you on that.
Maybe in the honestly, could be worse.
You think it could be worse?
Yeah, I think it could be worse. Right?
Do you think they were in Cabo in 2025?
They could. Actually, that's fitting. They actually took some time off. They actually underperformed in 2025. 20.
Actually, I have a spreadsheet. I can give you
most of 24. I mean, 24, 25 looked good. They took a back end trip to Cabo in the back half of 25, and I mean.
I think you're right. I think you're right.
I think they were in Cabo in 2025.
I think they were in Cabo too in 2025. I don't think those investor meetings went too well for them down there either. I think I'll put it in the middle so we have room to go on both sides of Cabo. Small cap active. We want to see outperformance in our actives. But at least they're not scamming you.
That's the other thing, right? It's like, you're stock picking rather than, you're picking an exposure in quad environments, right? Which is something that, Keith talks about all the time is one of the most important things. A stock picker, right, in the actively managed portfolios, right, going to die, right, rather than just looking at
it. Right, because you can either own these guys or you can own the Russell, and the Russell has a lower expense ratio and better performance.
Exactly.
So you just better outperform or be close to your benchmark, right? You can't outperform every year, but you want to be close. All right, so next we're going to a good one. This is the Dorsey Wright short, DWSH.
DWSH.
So
let's talk about this one.
We actually have this one in a product, ETF Pro. So their dividend is 6.7%, and their expense ratio is 6.2%. So whatever dividends you're getting, they're just making sure you collect them. They're going to try to match it.
Just a flat line. This looks like a heartbeat monitor.
Not one that you want.
Not one that you would like to see.
In 2025, they were down 2.6%. Relative performance in S&P was down 20.3%. Okay. By the way, you might say, no, they're supposed to be going down. No, these guys, like the way it's written, they're supposed to be good at short picking. It's to give you short exposure to the market, right. And let's just put it this way: maybe your short should not go up as much as the S&P 500. If you're doing that, you're a really good short seller, but they shouldn't be down about 60% since you've launched.
Yeah, I mean, shorts are hard, right? Especially in this, right, when the market is ripping and has ripped.
I think they're hard.
To be net short, right, risk assets is tough, right?
It's definitely tough, but this is bad. You can't be down 2.6% on when your whole thing is shorting.
Right.
If you're actually doing it, you should be up on your short.
Again, active, right?
This is active management. You're picking these out.
But again, it gets back to you're stock picking rather than picking equity style factors or certain sector styles, right? That you like or that makes sense in this quad environment, right? Yeah. And the cadence for that, obviously, they didn't nail.
But this is their job. This is their job, is to get these shorts right.
Yeah, and I mean, you have elevated transaction costs too, right? I mean, as we talked about, right, the 6% is one of the higher. It's certainly one of the higher ones on this list, but.
I mean,
what do you think? What do you think about positioning?
Here's the description. The fund's objective is to obtain short exposure of investment returns of U.S. large cap stocks, primarily using a relative strength indicator to capitalize on the downside of stocks that have recently appreciated relative to their peers. I think they need a new.
Interesting.
They need a new indicator. It's not working.
Yeah, I mean. It combines negative carry and poor timing, and just it's just in high fees, right, at the same time. So where are we ranking this one, Richie?
Well, I think what their fees is, I think what they're trying to do is just match whatever dividend you get. I honestly don't think that I think that's their whole goal. So they want to make their expense ratio at or above the dividends that you get, so that they get some money.
All right.
I think that's what they're doing. Where am I putting this? These are some hand-me-down shorts. These are not my kind of shorts.
Okay.
I don't want them. I lived my whole life on hand-me-down shorts. They got tears in them. I mean, some of them, you play sports. Some of them have blood on them. These are not the kind of shorts I want to be wearing.
Well, and also, yeah, I agree. I mean, it's just like if you're picking shorts and you're that because it's one thing to pick a short and have to pick a short and just be blatantly wrong on a majority of your picks, right, is really telling. I mean, is this scam service?
You're thinking scam service.
Is this worse? Is this better or worse than HYIN? I mean,
you think scam service?
What are you thinking? Are you going overpriced?
No, I'm going hand-me-down shorts.
You're going much lower. Oh,
I think it's I think these are as wild cards, in Cabo and shorts. I think
I'd rank it higher just because the short conviction.
Oh, I was having this as like these are the tiers. Like this would be like the S. What?
Yeah. S tier of bad.
S A. What is this?
I mean, Richie, this is a terrible.
But I just put this as random.
Oh, this is random.
This is like its own category.
Oh, I see.
Type of thing. hand-me-down, because it's,
I like it.
Because, you know, this was my play on words when I did this. This was the only one that I looked at before.
Oh, okay.
Because it's like shorts. They're really bad shorts.
Boom.
These are the shorts you don't want.
Hand-me-down shorts.
Yes.
You don't like shorts.
Yeah, I don't like their shorts.
Put it to the far left.
All right, I'll put it far left. Don't worry, we'll have another one of these for you to get all the way up where you want it.
DWSH.
DWSH.
All right.
All right.
What's next?
All right, let's go.
We have a little AI next?
Do we? Ooh.
News.
AI-powered sentiment. All right, these guys, normal dividend yield, normal expense ratio, but 2025 performance, they were down 4.1%. Relative return versus S&P down 21.8%. Down 4.1%. That is just, you're going to need some new AI.
Yeah, I mean, I'm curious on the composition of this, right? From a, you know, this is an actively managed ETF too, right?
Is it?
It actively managed US ETF. And it's interesting though, this is powered, this uses AI and NLP to drive new sentiment signals for these stocks.
Oh,
so there's a problem with obviously there's a problem with the algo.
The algo's off.
You know, you had the guy out back write the algo for this thing.
Maybe the algo's in Cabo.
Yeah, actually. Maybe that's actually incredibly fitting. The algo is in Cabo on a beach. You know.
It's interesting. Yeah, actually, looking at this, it looks like they almost like equally weigh it. Johnson & Johnson, Interactive Brokers, Coca-Cola. I don't know. Have those been in the news lately?
I mean, eBay's in here too.
Waste Management. That's a poop company.
I don't know if it's a poop company.
Yeah. Yes. Waste Management does your.
They do garbage.
Oh, okay.
Waste Management open.
Okay. Yeah, you're right. Garbage. Sorry, everybody. Sorry, I was trying to connect some dots here.
Flex, Intuit, Genpack. I mean, these are all like, you know, this is a broad mix of equities across sectors and caps and weights, right? Mostly low single digits.
Yep.
Yeah, they're in healthcare, tech, industrials, financials, utilities. You know, it's a little bit of everything, but, you know, that raises additional concern. Like if you're just going off a sentiment on certain stocks, like individual stocks, when in reality, you know, the flows might take a basket one way, right?
Yeah. Or it's just like what happens is with the algos too is you train your stuff, right? And you have a period, and I'm sure the algo worked whenever they trained it. And then, right, so then what you kind of see is 2024, right, it's actually launched. So maybe they're really excited about it. They have a good back test. Let's go. This is going to go well. And then all of a sudden, it just stops working.
Yeah.
And that's kind of typical, actually, for AI, because you're out of your test period, if that makes sense. You're no longer looking at it. You're in the real world. And sometimes the real world hurts.
This is actually a pretty funny one. What do you think on this? I think I have an opinion.
All right, hit it.
I think this is in Cabo.
This is in Cabo.
I think we're in Cabo. Is it better or worse than the small cap? Honestly, Richie, if it's me, I'm probably going. It's probably a little bit worse.
You're going left.
I'm going left.
Okay.
Just because.
How far left?
We can throw it in the middle.
Middle left?
Yeah, middle left. I think news, right? Anytime you get onto sentiment too, right? Like news is tough because I don't know. It's like you're trying to capture the flows, and at the end of the day, right?
Does the news even know what it's talking about to begin
well,
with?
That's the thing. Like, what does it capture? What's behind a paywall? I mean, it's just like there's so many things.
Down 4%.
Your handwriting's terrible too.
Is it?
I mean, my God, what are we doing here?
Yeah, I mean, if you want, right, you can write.
I
thought that was decent.
I got bullied in middle school for my handwriting, but.
So you're just passing on the trauma.
I mean.
News. That's better.
That's much better. Much better.
It was a W.
I mean, the K set me off in the KBWD, but anyway.
That is pretty
On
bad.
to the next. What do we have next here?
Ooh, another income opportunities, FCEF. These guys, they'll give you a 7 5.5% dividend yield, an expense ratio of 3.7%. Okay, their absolute return last year, not bad, 14.4%, but your performance relative to the S&P 500 was down 3.3%. When we look at relative to the SPY, since 2020, they have yet to outperform. So they were down 3.3%, then down 7.4% in 2024, down 16%, then down 1%, then down 9% versus the S&P, and down 14% since versus S&P in 2020.
And this is a fund of funds, right?
Yep.
So it primarily holds those closed-end funds and some income ETFs.
Exactly. That's what they try to do with these income ETFs.
It's interesting.
They go to these closed-end funds and say, we can pick the best closed-end funds that you can't get to, but since trust us to give you this. And then they're like, we also have this massive dividend yield. Man, let's see.
This is,
This is, I don't know. Nobody's
the holdings, the holdings predominantly have CEFs, right, which trade at a premium to the NAV. Just spike in volatility, which could hurt performance, right? Obviously, that's been the case. What do you think, Richie? What's your gut saying on this one?
I think with a passion, all these income ETFs, I think I just hate them.
You just hate them.
I think maybe I'm biased towards it, but I just really don't like it. I'm sure somebody would say, well, maybe it's better than having high yield or something, but when you look at some of these drawdowns, they're big drawdowns. They're still having the same drawdowns. The dividends are big, but they're just having high expense ratios on the other end. So really, you're not taking home 7.5%. You're taking home 3%.
You're right.
That's where
But better trends, right? Getting on a year-over-year basis, right? An annualized basis relative to the SPY. I mean, it's not great, right? But when you think about wall of shame,
I'm between average and it could be worse.
I was thinking could be worse.
Okay.
That's kind of where my mind was going.
We'll fill it in right in the middle.
Throw it right in the middle.
Right in the middle.
Right in the middle.
FCEF. Wait, I really gotta get it on EF. See, when I focus, it's not that bad.
All right. What's the next one?
All right, next one. Oh, this one.
Oh, Lord. Okay.
Bitcoin in Treasuries rotation strategy. Ticker BITC. Okay, dividend yield is 3.4%. Expense ratio is normal, 0.9%. Okay, but their performance in 2025 was down 20%, and relative to Bitcoin, that's down 14%. All right, the strategy that they're using is essentially, it's a risk-on, risk-off strategy. So essentially, if they think Bitcoin's not going to do well, they put your money into treasuries, and if they think Bitcoin's going to go pop off or outperform, you're in Bitcoin. Here's the problem. They're not really doing this whole risk-on, risk-off thing. They're out at the wrong times. It really looks like they're getting they're in at the peak.
It's the rotation, right? The rotation just doesn't make.
It's not working.
The strategy just between Bitcoin and treasuries just doesn't make sense. And obviously, I mean that you can imply that from what you're looking at on the screen, but when you have signals and news-like events, right? I mean, it's you miss Bitcoin's upside, right?
Right.
The returns. I mean, it's just
they're missing Bitcoin's upside and they're eating their downside.
It's almost like you de-risk too often, right?
Yeah.
You're rotating too often or too early, or after you re-engage, right? After these large moves, you're late to the party.
Yeah,
almost is kind of my.
That's my take on this
Bitcoin's
too.
A party, man. Bitcoin's a party.
I love a good party.
We have some friends who like Bitcoin. We have some friends, some NexGen
we do.
Some NexGen alums who like Bitcoin.
They do like their Bitcoin.
But I think that it's just
they need to tune this algo a little bit more. It's missing the upside. Absolutely. And it's eating the downside. It's not there yet. It's not doing it for me.
So where are you putting this? What do you think? I mean,
I'm going I honestly think this ETF, if the only way you're ever going to see this thing outperform is if Bitcoin all of a sudden goes down like 90%.
Okay.
Otherwise, if Bitcoin like meanders upwards but is a little choppy, I think this thing is going to have really bad performance relative to Bitcoin. So I'm going. I don't like it. I don't think it's a scam. I think they're trying their best. They're not bad people out there.
Could be worse.
It could be worse. It could be worse.
Is it better than the fixed income, the FCEF though? I think so.
No.
Is it?
No, I think it's worse.
Lower expense ratio?
I think it's worse just because
I
don't see them. I don't see them performing.
I like it.
I don't see them
Because
they probably go to their clients like, "We'll help you on the downside of Bitcoin,"
and especially to just like the Bitcoin strategy, it doesn't make any sense. All right,
I'm going here.
Oh, that's what I meant. I meant left.
Oh,
I meant left.
We're on the same.
I meant
we're
left.
On the same page.
Usually, Richie, these S tiers. I'm thinking S tier like God tier in the best way.
I know.
I got to get my head wrapped around. All right, we're good. We're on the same page.
All right. We got another fun high income ETF. Wait, did we already do KBWD?
Yeah.
Oh, we did.
We got Y.
Okay. No, I have some notes, but they're random. They're random. All right, CEF. It's a high income. Y. Three Ys. These guys, here you go. You got your 12.2% dividend. By the way, CEF stands for closed-end funds. So they're a fund of funds to give you high income. Their dividend yield is 12.2%, expense ratio of 3.3%. The performance in 2025 was up 13%, and the relative performance to the S&P 500 was down 4.7%. Relative to the S&P 500, they have yet to outperform since 2020. They stay in line with their benchmark. Problem with some of these benchmarks too, by the way, these own companies are making the benchmark. And so yes, they're in line with their benchmark that they made. Yeah. So it's like, congratulations on making a benchmark and trading the same thing.
Yeah, right? I mean, it's just like...
So that's why I hate the benchmarks. And then, as you guys know with me and these dividends,
it's not tactical, right? It's not signal based. You're just like lobbing it up there, and you look at the performance, and it's just like, it's better. I don't know if it's better than the actively managed just underperformance, but these fund of funds that don't outperform, like it's just like.
Is the dividend really that worth it?
I think it's a scam. I think it's
your own scam.
I think it's a scam, and I think we go right of KBWD.
All right. KBWD.
That's my opinion.
Dude, like KBWD.
This is a piece of shit. I mean,
you're going right here.
YOY.
Here's the thing with these things, right? Because if you have a high dividend yield, you shouldn't have as much volatility, right? That's kind of what somebody would say to you if you went to school. Like KBWD had a 20% drawdown consistently.
Yeah, right.
What are you doing? Why are you doing? Fund of funds. All right, let's go next. BDC income. BIZD is the ticker here. This is a good one for you. Dividend yield 11.5%. Expense ratio 12.9%. But 2025 performance, by the way, that all includes the fees and dividends, was down 5%, and relative to the S&P 500, it was down 22.7%. We're staring down an expense ratio of 12.9% right now, guys. That's bad. That's bad. They've shown a little bit. If you look relative to the S&P 500, they have shown a couple of years of outperformance in 2023, 2022, and 2021. But man, was 2025 a terrible
year. When you look at this, Richie, right? Yes, they did have some moments where they, showed some promise, but this is one that is structurally incapable of compounding capital.
Yes.
You have monster downswings, right? 2025, terrible. And in a market that was pretty good, right? And when you consider the back half
I don't think you would guess how much AUM these guys have.
Oh God, do I want it?
1.2 billion.
Wow. To do that, to go down 22, down 23.
But I think worse than that is, hey, here's this income ETF, but by the way, I'm going to charge you an expense ratio that's higher than the dividend that you're receiving.
Right.
So net, you're not getting a dividend. What you're really getting is an expense ratio of about 1.2%, with an income as income almost seems like here, come into my house, it looks nice, and all of a sudden you walk in and it's like Home Alone, and it's a trap door and you fall right through.
It almost like similar structural problems to PBDC in a way.
It
right?
does. It does.
There's no macro environment where this thing significantly structurally outperforms.
I wonder where Chat thinks this should go. Chat? Right, it just doesn't outperform.
I mean, yeah.
I think you're right with this. I think somebody's getting paid.
Chat looks like Dorsey Wright's stock performance just flatline right now. But this is S tier. This is absolutely S tier.
You're on S tier?
Yeah, this is S tier. And I think it's right after PBDC. You can put it in the middle, but I mean this is terrible.
Wait, what was PBDC's expense? PBDC's expense ratio was 13.5%.
I mean, that's crazy.
Oh my God! So
like
these guys
setting the tone.
These guys are at 12.9.
Yeah, I mean this is right. This is right after.
I'm with you.
This is right after him.
This is a CEO is on a yacht right now, having a great time with this thing.
Oh God.
Oh,
the yacht fund.
Give us the yacht fund.
All right, what's next, Richie?
By the way, guys, we meant to do this for, if you have an advisor too, we won't share the actual advisors, but show us your performance. Send in your performance. We want to see the fees that you got, the
or
fees
what
that you
ETFs
pay.
you like. Or not like.
No. No. Send them to NexGen
That's
at hedgeye.com. You can also send us the ETFs you like. But yeah, if you don't know what you're paying, you can just send it in and I'll figure out what you're paying.
Ooh.
I'm free.
What a nice guy.
I work for free out here.
What a nice guy.
Here we go. We got our next one out. Durable Growth, GRW. All right. Dividends 0.3%, expense ratio 0.8%. You got performance in 2025 was down 5.1% in an up market, making their relative performance down 22.8%. These guys are all about growth. This is one of those active funds that are like,
yeah, I mean,
we need long-term capital appreciation. So the fund mainly invests in equity instruments that will benefit from transformation as a result of technological innovations, market dynamics, and or changes in client preferences.
I mean, right away, right? Like my mind goes to this could be worse, right?
Yeah.
This could be a lot worse, right? Low expense ratio.
Yeah.
Dividend is fine, right?
Yeah.
It's relatively in line, right? They say it's durable growth.
Yeah.
That implies higher quality names, right? But the actual components, the broad, I mean, I'm looking at it right now, right?
Yeah.
Overlapping holdings with SPY, Qs, pretty generic growth indices, right? The durable label is really.
I think down here.
It's just, you know what it is? There's nothing to differentiate this
No.
one, right? And so I like could be worse.
They did have a couple good years in there, so they're
Could
not
be worse. Could be worse.
We'll go down here.
GRW.
W. They might have been in Cabo. That's all right. Oh, okay. This is one.
Good
Multi-QIS alternative. QIS is the ticker. Their dividend is 3.3%. Expense ratio 1.2%. 2025 performance, including dividends, they were down 38%.
That's just a quant failure.
Relative to S&P, they have been down 55.7%. 2024, their absolute performance in 2024 was down 24.7%. I think that's right. Wait, let me look that up before somebody yells at me. Let me look up QIS. Yeah, QIS. Okay, no, they're okay. That was relative performance on that chart. So their relative performance to SPY in 2024 was down 24%, and 2025 was down 55.7. My bad on that.
It's brutal.
That's brutal, bad,
right? And there's no smoke and mirrors with this one. There's no illusion, right? This is just
it's
just structurally bad.
Structurally, something is wrong. Structurally, something is wrong.
I mean, is this in Cabo? I mean, are people paying attention? Like, the expense ratio isn't bad. The dividend's not bad, right? But the performance is just abysmal, right? I mean,
they might be in Cabo. They might be in Cabo since they launched.
I mean, it's just like.
You want to go top of Cabo?
Yeah, I like that. QIS?
I think they've been in Cabo since they launched this thing.
Yeah, okay.
Something's going wrong. Whatever the strategy is,
just brutal.
It is not it.
What do we have next? A little risk?
Oh, tactical risk. So BTR, everything's normal. Dividend 1.2, expense 1.1. 2025 performance, though, they were down 2.1%. Relative to S&P, they were down 19.9%. And then that should probably say relative performance again. My bad, everybody. I was rushing. 2024, they were relatively down 10.4% versus S&P 500.
It looks like they're trying to overlay, right, and tactically, U.S. equities, cash.
Yeah, right, essentially, it's another risk on, risk off. That's
and this is actively managed? Oh, man.
Yes.
This is brutal.
For long-term capital appreciation.
And getting worse, right, in terms of their relative performance, that number getting worse, right? It's like, I don't know. There's no edge. Where's the edge? There's no edge here. You're overlapping.
This is negative edge.
This isn't even the could be worse. This is just like. Are you leaning higher up? I mean, the expense ratio.
I think I'm leaning higher up. I mean, I don't think they're scamming us.
No, I don't think they're a scam.
I just think they're. Well, I mean, they honestly might be. Since 2023, they are up 7.9%.
I think this is top of overpriced average or bottom of premium scam service. But it's not a premium expense ratio. So
let's go top of here because we got to fill it in.
I like the C tier. Fill it in.
BTR. That'll work. That'll do.
Ranger. What do we got next?
Ranger Equity Bear.
This thing looks great.
HDGE. Dividends of 3.5%. Expense ratio of 3.6%. Their 2025 performance, they were up 1.5%. Relative to the S&P 500, they were down 16.2%. Here is what these guys, they are an active bear strategy. Okay?
Well, they look good.
Let's pull that one up for them to see. They are down since they've launched 91.9%. This is HDGE, Genron. There we go. Yeah. Whew.
I mean, this is brutal. When you look at oh man.
Dude, the fund's objective is capital appreciation through short sales of domestically traded equities and securities.
Yeah, they're all in high multiple, right? Cyclical businesses, companies with deteriorating fundamentals, but it's also highly sensitive to factor rotations and short squeezes, right? I saw a lot of that in some of the fast casual restaurant shorts, right? It's like you get squeezed. I mean, and it's just no.
They've been getting squeezed since 2011. Capital appreciation. It should be all about capital depreciation.
Richie, the boat to Cabo is
I don't even think
Is this a hand-me-down short? Is this
dude? I'm this is. I don't know. This one gets me going.
Is this
because here's also what they did with this expense ratio. Okay. Dividend is 3.5%, expense ratio 3.6%. They take home the 0.5% normal expense ratio. So that's how they did that math for you. This is bad.
Richie, this
is broken.
This isn't even though. This isn't. Oh yeah. This is but is it a scam?
Their short calling is a scam, but maybe now people know that they just don't know how to do shorts.
I got.
Where are you going?
I'm going scam service.
You're on scam service?
I'm on scam service. I'm trying to think what side of the ledger I want to go on
Let's
here.
see. HYIN. Let's see how they did. This is like.
Yeah, I mean, this is.
I think it's worse than HYIN.
Yeah, let's go all the way to the left.
All the way to the left.
I gotta fix my directions here.
What is this? HDGE. HDGE.
Almost sounds like if Hedgeye had a ticker, that would be Hedgeye's ticker.
Well, maybe
I wouldn't want that track record.
No, maybe they get liquidated and we can take it. All right, we got another one coming as mid cap growth, TMFM. Okay, everything's durable on dividends and expenses. Nothing's wrong there. But their 2025 performance, their Bennett, was down 9%. You're down 9% in 2025.
This is just an active equity underperformer, right?
Yeah.
This is your primary exposure in mid cap growth, right? Broader growth indices.
Exactly.
Indices with mix in industrials, tech looks like a little bit of discretionary too, right?
Oh.
Is this differentiated alpha, right? This is just mid cap beta.
No, this is literally, they're supposed to be giving you alpha. By the way, the people who launched this one are our dear friends over at the Motley Fool. Looking like
that's awesome.
They're not looking too good right now.
That is awesome. Are you serious?
I kid you not.
Really funny.
This is their ETF.
Yep. Okay. That's really good. Yeah, I mean this is F tier. No, this is.
Yeah, I mean
they're
just by the name alone we have to put
this is overpriced average. This is very much like, and maybe what do you think? I mean,
I think just for the name alone, I'm a little biased on how far up we should put it. But
scam service, mid cap growth,
maybe right under BTR.
Isn't that what I said?
Yeah, that is what you are.
Okay. All right.
Yeah.
Throw it up there. This is the most average, like, it's mid cap growth beta, and you can't nail your 2025 performance. I mean,
2025 performance.
Granted, 2025 performance of mid cap beta in the restaurant space wasn't it's not stellar, right? So I could see how they could.
But look on the chart. Look on the chart.
I'm looking at the chart.
Look, that's mid cap growth. That's their index.
Chart.
That's their index.
And you know what? You know what's interesting, right? Mid cap growth, right? And you look at the performance after since
2021, 5 years.
I'm looking at since April of last year.
Yeah.
Right. You miss all of that pretty much, right? That's where the big divergence is.
They missed the entire upside, and look how much downside they ate.
So this is and it's probably even worse than average, but I mean, this is where that goes.
Yeah.
We got to keep moving here, Richie.
All right, we got to move quicker. Breakout opportunities. Actually, we're at 16. We have 19. So we have four more.
We got four more.
Four more.
Each one a minute.
Yes. Breakout opportunities. BOUT. I'm still waiting for the breakout with this one. All right. Their 2025 performance was down 6.8%. Relative to SPY, was down 24.5%. If you look at their relative performance since 2021, they have yet to have an outperformance year. I think their holders are waiting for that outperformance too.
I got scam service. I got, this is in high beta names. I mean, portfolio turnovers looks like it's high, right? Yeah, they're chasing gains. I got this is scam service. Charging a higher expense ratio, not too high,
but
not
too bad.
When you look at performance, I mean,
this is bad. There's no outperformance.
No, I got scam service. I got all the way to the right of scam
You're going
service.
right.
Yeah, that's right. That's what I got.
All right.
BOUT.
BOUT.
Maybe they'll break out.
Maybe. You know what?
VPC. Private. Oh God. Private.
All
credit.
right. Private credit strategy. VPC. Dividend yield of 14% with a nice hefty expense ratio of 9.9%. Their total performance, net of all fees and dividends, or including dividends, was down 6.7% in 2025. Whew.
I mean, this is Richie. We might be on the yacht here.
9.9%. I don't get how they're getting away with this.
I mean, this is yacht. This has got yacht fund written all over it, right? I mean, this is, they're in BDCs, right? This is another one of those, right? I mean, this is
bad.
Yeah, I got a yacht fund.
Let's go yacht fund. The CEO's on a yacht somewhere having a good day. While we're here in the office.
Just illiquidity.
Let's go right here. Let's go right here. I mean, how do you get away with charging 9.9% expense ratio?
You're on the yacht.
You're on the yacht. All right, here we go. Full cycle trend. All right,
this one's interesting. Tell me about this one.
It's just another one of the tactical growth type, right? Like, I can get the full trend, but really just come look at my performance and I'm not doing too well. Their 2025 performance was down 3.8% relative to S&P. That's down 21.5%. They haven't been around that long just to begin with. They did okay in 2024, but like, what trend? We're missing all the trends.
I mean, you'd like to think, right, that you participate in up markets, right, and reduce exposure in down markets, and obviously they just fail to do that.
They got a lot to prove to me in 2026.
Is this now this?
I think they're in Cabo right now.
Oh, you think we're going all the way up there?
Yeah. I think they're in Cabo in 2025. They launched in 2024. They had some nice champagne.
Okay.
And all of a sudden, a couple too many.
I like it. Where are you going? Okay.
Right here.
I like it. Yeah, I like it.
What do you think?
No, I like it.
What was that?
It's better than small.
FCT.
FCTE. We got one more.
We only have one more, everybody.
Value appreciation. All right.
Let's see.
MVPA.
Wow, man. I made it alive. This is cool. A lot of garbage ETFs. Oh, Zach. Thank you, Zach, for being in the chat. There are a lot of cool garbage ETFs out there. Cabo is going to take their line. Yeah. I like that.
It's true, right? I think the ham.
Thank you, Zach.
The ham ETFs, right? Not to get out in it, but talk about the people.
Yes.
Talk about the people, right?
Yes.
I think one of the big pushes from ham, right? Like the ham that you eat, right? Of course. We're not
all right.
No, but the people managing it, right?
We had actually on the podcast was RPK. Everybody got to see RPK, meet RPK. He's a great guy. We love RPK.
Sam and David Salem, obviously, as well, too.
All great people.
Right? Managing, their tickers. But great people, but also transparent.
Yes.
Right? Yes. And I think that's one of obviously a key value of Hedgeye.
I think that's all we can say.
But that's all we can say.
Value appreciation. MVPA, I think we're...
I mean...
normal dividend, normal expense ratio. Here's the thing with them. Their 2025, it was not good. Down 2.9% in an up market. I think we're still waiting for some value to be appreciated here.
Yeah, I don't think this is scam, right? But this is, honestly, I mean, I would probably put this in, it could be worse.
Okay.
I don't want to put it next to the Motley Fool. But this could be worse, right?
Yeah.
I mean, you have bad performance, right? But you look at the expense ratio, the dividend, right? I mean, it's not...
Where you go? I mean, right here?
A little open spot.
Okay.
Give him a Christmas present. MVPA.
MVP.
And Richie, those are all the ETFs.
That's it.
Do you have any closing? Do you have any comment? What's the?
I think my closing remarks here are. Well, I think we'll throw up the slides to really highlight our yacht fund, right? Because I mean, we gotta appreciate the yacht fund.
I like the yacht fund.
And so, but I think closing, guys, NexGen at hedgeye.com. You send us tickers, we'll throw them up on this board. This might become a permanent background. If you guys got entries for this, why not?
We'd love to hear.
We'd love to hear.
We'd
love to hear it. We want to hear your horror stories, right? I'm sure we got people who've been investing for a long time. They may have some horror stories from back in the day.
You know what we should do?
I want to hear it all, Bennett.
We should do the best wall.
The best. We can do a wall of fame.
Wall of fame.
Wall of fame.
We've done a wall of shame. I think a wall of fame, and we give the people some ideas, this isn't investment advice, but at the same time, hey, this is not bad.
Okay. You know what? We can do a Wall of Fame.
I think a Wall of Fame would be nice.
Wall of Fame, but still send us your horror stories. How about that?
We'd love to revel in the...
We want your horror stories at nextgen@hedgeye.com. I'll read them because it goes right to me. So if you want, I'll just...
There's only one person on the distribution list. You can email Ryan Ricci.
No, I don't even know that one.
No, that email actually doesn't work.
That one doesn't exist. But yeah, we want to keep adding to this. This will continue going. Let's just quickly highlight. Let's go from worst. Let's go put up VPC, General. Let's just show everybody.
VPC.
This was our yacht club, everybody. VPC. This was slide. We'll find it
right here.
What slide number?
At the end, 17.
Slide 17. Here we go. Here's your VPC. They're charging their clients a 9.9% expense ratio and telling them we give you a 14% dividend.
BDC income, slide 10.
BIZD.
Is BIZD.
So slide 10. Here's your number 2.
Number 2.
Number 2 biggest yacht. BDC income, they have an expense ratio of 12.9%, and they're telling their clients we give you a dividend of 11.5%.
Insane.
So literally, they're not even getting a dividend. They're actually just paying about 1.4% expense ratio. So thank you for coming out there.
And the final, slide 1, PB, DC.
These lovely fellas, here is your number 1 CEO yacht club payer. Expense ratio of 13.5%, dividend yield of 10.4%. I mean, they're pretty much netting 3.2%. But I'm just in the meeting right now where the people of this, they're sitting with their client, high net worth client, saying, you know what? We got this thing, income. You're going to retire soon, so give us your money, and we'll give you income off of all this.
Yeah,
so
I mean, it's just...
we'll give you 10% a year, 10% a year. But maybe they don't really tell them we're charging you 13.5%.
Brutal.
That's your CEO Yacht Club, everybody. Thank you for joining us. You got any closing statements?
No, another great NexGen, and we'll be back soon.
Yep. Hedgeye Food. Make sure to follow. You're doing a lot of food content. He actually tries the buns. All right. If you've seen the buns.
Burger bun.
Burger. I mean, we're the burger
food. All the food.
Well, we're the burger buns on the scam list.
Scam. I mean, we could rank some restaurants.
We should rank some restaurants.
That would actually be a fun exercise.
Let's flip it around. We should rank some restaurants.
We could rank some restaurants. That'd be fun, actually.
That could be good. Thank you, everybody, for joining us. We'll be back in 2 weeks. We're Hedgeye NexGen. Thank you, and good luck.